Sam Zell, arguably one of the greatest investors alive, was recently interviewed on CNBC, where he stated that he felt that the Fed had completely screwed things up and was playing catch-up on fighting inflation. I thought this interview was extremely interesting, and try and bear with the insipid questions of the interviewer, which are typical lamestream media pablum. Anyway, enjoy. I think this is a very interesting interview, and I think encapsulates exactly what I think about the current interest rate and Fed tightening situation.
Billionaire investor Sam Zell of Equity Group Investments joins me here at Post 9. It's good to see you.
Good to see you, Sarah.
So there has been a bit of a rethink in the markets about recession. Is that something you still expect?
I haven't gone through that rethinking.
You're still negative?
Negative is the wrong word, but when you spread out free money for years at a time, you create, significant drag, and I just don't see how we're going to avoid a slowdown as that whole process comes to an end.
Well, I guess the idea would be that the Fed would get really lucky and engineer a soft landing here because the data's strong, the labor market is super tight, and inflation is starting to come down.
Yeah, but is the definition of coming down going from 9 to 6?
Well, it's yes, and then it has further to go. Sure.
Well, but the point is, six is a
still
serious
very high.
problem.
Yeah.
And
so you think the Fed's going to have to do even more than the market expects?
I think that I think the Fed screwed up by allowing it to the zero interest rates to go on for too long. I think we're just beginning to pay the price for that. And it'd be nice to say that it'd be great if the Fed got lucky. I've been around for 50 years, and I've never seen the Fed get lucky. All I've seen the Fed do is mistake in terms of not acting fast enough.
So how do you take that view and prepare some of your companies and your portfolios for that eventual outcome?
I think you basically do two things at the same time. One, you prepare for higher interest rates and higher costs. And then at the same time, you also prepare for dealing with inflation. So a year and a half ago, we went to our companies and said, hard to imagine we're not going to have significant inflation. And we need to prepare for it, not respond to it. So in effect, we reached out and changed a number of our policies to prepare our companies for escalating costs.
Are you now preparing for disinflation, or you're just not convinced it's there yet?
Preparing for disinflation would be a very optimistic thing to do at this point. I think it's going to take a while for the inflation pressures to ease, and I think that's what we have to look forward to.
Sounds like you think the stock market may be a little too excited about this notion that inflation is coming down and the Fed's going to pause.
The stock market has a long track record of being too excited about everything, both negative and positive. And I think, when the stock market reflected the fact that interest rates were going up and inflation was a problem, it was a little slow to pick that up. And then at the first opportunity, the stock market has gone and flipped and said, everything is wonderful, and we're going to have a soft landing. I think both those extremes are unsupportable.
What about real estate, which is a big business for you? It's what you're known for. How much is real estate off the lows, if at all? Because we have seen mortgage rates come down.
Yeah, but think about the fact that if you had bought a house in January or February or last November, your mortgage rate would have been 2, and today it's 6.
Yeah,
that's
still high.
That's a pretty staggering jump in a relatively short period of time, and I think there's just going to be, I think the real estate industry as a whole is got to deal with bullet loans and all kinds of things that were the result of very, very low, unrealistically low cost of capital.